Every global empire in history had one thing in common: control over food. Today, BRICS isn't just talking about shifting trade away from the West. It's quietly setting up a global grain monopoly that could reshape how food is grown, sold, and priced. Right now, just four Western agribusiness giants, Cargill, ADM, Bunge, and Louis Dreyfus, control 70% of the world's grain trade. But BRICS, they're flipping the script. Their plan? A grain cartel built like OPEC, designed to challenge Western dominance. But what does this mean for your food prices, your economy, and even global power struggles? Is BRICS about to dictate the price of wheat and rice the same way OPEC dictates oil? Global food trade has been controlled by a handful of Western firms for decades, but that power dynamic is shifting. BRICS is quietly restructuring the $1.8 trillion global grain market, consolidating its influence over wheat, corn, and rice exports. With Russia controlling 24% of global wheat exports, Brazil dominating 55% of global soybean exports, and China stockpiling 140 million metric tons of grain, more than half the world's reserves. This alliance is moving to create a food supply network that bypasses the West entirely. According to Bloomberg, Russian wheat exports in 2023 surpassed those of the US and Canada combined, solidifying Moscow's leverage over global supply chains. If BRICS aligns its grain policies like OPEC does with oil, it could dictate food prices for billions, something Western governments are already warning could trigger inflation and shortages. OPEC controls nearly 40% of the world's crude oil supply, allowing it to influence prices with production cuts. If BRICS replicates this model for grain, the global food system could be reshaped overnight. According to the UN Food and Agriculture Organization, wheat, rice, and corn make up over 50% of the world's calorie intake, meaning price manipulation could have immediate consequences for consumers. Russian Agricultural Minister Dmitry Patrushev confirmed that Moscow is already in talks with BRICS partners to set up a coordinated grain export policy, which could restrict supply to certain nations while offering discounted prices to allies. Meanwhile, China's growing stockpiles, covering nearly 18 months of domestic consumption, give it the ability to flood or withhold supply, much like Saudi Arabia does with oil. The Financial Times reports that Beijing has been quietly accumulating reserves through strategic purchases from BRICS nations, reducing its reliance on Western suppliers. If BRICS moves to collectively regulate grain flows, global food costs could be dictated not by free market forces, but by geopolitical alliances. The closed-door BRICS summit in Cairo this year wasn't just about trade. It was about rewriting the global food order. A leaked memo from the BRICS Trade Forum obtained by Reuters outlines plans for a grain pricing mechanism in local currencies, bypassing the US dollar entirely. This would undermine Western grain futures markets in Chicago and Paris, which currently dominate global pricing. Brazilian Finance Minister Fernando Haddad stated that BRICS is laying the foundation for a self-sufficient food trade network, signaling an intent to decouple from Western agribusiness dominance. Russian officials pushed for the creation of a BRICS grain trading exchange, where BRICS nations could trade commodities exclusively in yuan, rubles, and rupees. Meanwhile, China proposed an AI-driven agricultural supply chain that would use predictive analytics to optimize crop exports across BRICS nations, reducing reliance on Western market fluctuations. If these initiatives move forward, the West could lose its grip on one of the most vital economic levers: food security. Four corporations, Cargill, Archer-Daniels-Midland, ADM, Bunge, and Louis Dreyfus, control nearly 70% of the global grain trade, giving them disproportionate influence over food pricing. The Wall Street Journal reported that Cargill alone generated $177 billion in revenue in 2023, capitalizing on price spikes caused by supply chain disruptions. These firms don't just dominate exports. They own global storage facilities, transport networks, and futures markets, effectively determining who gets access to food and at what cost. Western financial institutions reinforce this dominance through grain futures contracts, which allow traders in New York and London to speculate on global food prices. The U.S. Department of Agriculture confirmed that over 60% of grain exports from Latin America and Africa pass through Western-owned firms, limiting local farmers' ability to negotiate fair prices. BRICS grain strategy directly threatens this system by shifting trade towards state-controlled channels and local currency transactions, cutting Western middlemen out of the equation. The proposed BRICS grain exchange, expected to launch in 2025, aims to challenge the $600 billion global grain futures market, currently dominated by Chicago and Paris. Russian Economic Minister Maxim Reshetnikov stated that the exchange would operate using a multi-currency settlement system, reducing dependence on the US dollar. If successful, this could allow BRICS nations to set their own grain prices, independent of Western financial markets. A report from the Financial Times indicates that Moscow and Beijing have already executed their first grain trades in yuan, bypassing Western banking systems. Brazil and India, both major agricultural players, are expected to follow, further isolating Western agribusiness giants. Critics argue that such a system could introduce new monopolistic risks, where BRICS nations prioritize political alliances over market efficiency, much like OPEC's controversial oil production strategies. However, for many developing nations, the shift could mean greater negotiating power and reduced price volatility. In February 2024, China halted wheat imports from the US and Australia, citing biosecurity concerns, but trade analysts see a clear geopolitical motive. According to Bloomberg, China has diverted over 8 million metric tons of wheat imports to Russia and Brazil, a move that aligns with BRICS' broader food independence strategy. This shift has already cost U.S. wheat exporters over $3.7 billion in lost trade, while Australian wheat shipments to China, previously worth $2.5 billion annually, have plummeted by nearly 70% in the first quarter of 2024. Industry experts warn that this could be part of China's long-term strategy to erode Western dominance in food trade, using BRICS as a unified alternative supply chain. Australian Agricultural Minister Murray Watt stated that China's sudden shift toward Russian wheat was politically motivated, adding that Canberra is seeking WTO intervention. Meanwhile, the U.S. Grain Council is lobbying for retaliatory tariffs, a move that could escalate into broader trade restrictions. With BRICS nations solidifying their grip over global grain exports, Western suppliers may soon find themselves locked out of the world's largest markets. Western economies, led by the United States and the European Union, are escalating their response to BRICS' growing grip over global grain markets. The U.S. Department of Agriculture announced a $7.1 billion subsidy expansion in early 2024 to counterbalance cheaper BRICS exports and prevent domestic farmers from losing market share. Meanwhile, the European Commission has imposed stricter import tariffs on Russian and Brazilian wheat, a move aimed at reducing BRICS' price advantage. However, Bloomberg reports that despite these efforts, U.S. wheat exports fell 14% in the first quarter of 2024, marking a sharp decline as BRICS nations shift to internal trade agreements. Washington is now lobbying the World Trade Organization to investigate BRICS' pricing strategies, arguing that the bloc's new grain exchange undermines fair market competition. The Financial Times notes that BRICS' ability to bypass the Chicago Mercantile Exchange in grain pricing could weaken Western financial markets that rely on futures contracts, making this a high-stakes economic war that extends beyond agriculture. Tensions are escalating as BRICS nations aggressively restructure global food supply chains, prompting retaliatory measures from Western economies. The U.S. Trade Representative is considering sanctions on Russian and Brazilian grain exports, while European wheat producers are calling for stricter quotas on BRICS agricultural imports. According to Reuters, India and Brazil have increased bilateral grain trade by 27% since late 2023, reducing demand for US and European crops. Moscow has responded by limiting wheat exports to NATO-aligned countries, with Russia's Deputy Minister of Agriculture, Sergei Levin, confirming that 85% of its grain sales now go to BRICS partners. This realignment has already impacted global food prices, with wheat futures on the Chicago Board of Trade rising 9.6% in March 2024, according to the Wall Street Journal. The G7 is now debating new agricultural tariffs on BRICS nations, raising concerns that food supply chains could become as divided as the energy sector after the Russian oil embargo. While BRICS positions its grain strategy as a shift toward farmer empowerment, critics argue that the consolidation of supply chains under state-controlled entities could instead mirror Western agribusiness monopolies. China has invested $4.2 billion into AI-driven agricultural technology, with a 2024 government report confirming that 62% of China's farmland will be digitally managed by 2025. Russia has launched a blockchain-backed grain tracking system, aimed at optimizing trade between BRICS partners, but also increasing state control over pricing. Brazilian Agriculture Minister Carlos Favaro claims that BRICS digital infrastructure will level the playing field for developing nations. Yet data from the International Food Policy Research Institute suggests that small-scale farmers are already struggling to adapt to centralized pricing systems. The transition could leave independent growers dependent on state-owned trading firms, much like the dominance exerted by Western agribusiness giants. The Financial Times reports that BRICS-aligned agricultural corporations now control 31% of global grain shipping routes, meaning the bloc's influence is extending far beyond digital infrastructure into logistical dominance. Food costs are already reacting to BRICS' growing market control, with U.S. grocery prices rising 4.3% in the first quarter of 2024, driven largely by higher wheat and corn import costs, according to a report by the U.S. Bureau of Labor Statistics. The shift in global supply chains means that Western nations now face longer and more expensive import routes, while BRICS nations are trading grain at discounted rates among themselves. In contrast, countries reliant on BRICS grain imports, such as Egypt and Indonesia, have seen a 12% drop in wheat prices, per a 2024 World Bank report. The key concern now is whether this fragmented trade landscape will stabilize, or if food markets will become permanently divided. The United Nations Food and Agriculture Organization warns that continued tariff escalations could drive up global food insecurity, particularly in regions dependent on subsidized Western grain. However, for BRICS-aligned economies, the new structure could mean cheaper, more stable access to staple crops, shifting financial burdens onto Western consumers. The current trajectory suggests that global food markets are heading toward a split between BRICS and Western economies, with separate pricing structures, trading platforms, and supply networks. In a 2024 Financial Times analysis, agricultural economists predict that by 2026, over 60% of all BRICS grain exports will be traded outside Western-dominated futures markets, effectively rendering institutions like the Chicago Mercantile Exchange less relevant in key markets. Russia and China's recent $50 billion food security pact, which guarantees mutual supply protection against Western sanctions, signals a long-term commitment to this divided system. Meanwhile, the European Commission is exploring emergency subsidies to prevent mass bankruptcies among small-scale farmers, whose profit margins have been eroded by BRICS' lower grain prices. A Bloomberg report from April 2024 states that G7 nations are in discussions to counter BRICS' food dominance by expanding partnerships with Argentina, Canada, and Australia. But experts warn that this could take years to offset BRICS' current momentum. If food markets remain geopolitically fractured, consumers worldwide may soon experience two parallel food economies, one dictated by BRICS, the other by Western-led institutions. Supporters of BRICS argue that decentralizing grain trade from Western control allows developing nations to negotiate better prices. But critics warn that state-controlled trading platforms could simply create another monopoly. A 2024 Reuters report highlights concerns that BRICS's new grain exchange may prioritize geopolitical alliances over free market competition, mirroring past Western trade policies. Chinese agriculture officials claim that their $12 billion investment in Africa's grain production will empower local farmers. Yet industry analysts note that Chinese firms still control the majority of infrastructure in those regions. Meanwhile, Russian wheat exports are increasingly directed to politically aligned nations, with Moscow cutting shipments to Europe by 40% since 2023, according to Bloomberg. This raises the question, is BRICS truly breaking corporate monopolies, or is it simply shifting control from Western agribusiness giants to state-run entities? The answer may determine whether the world sees a more equitable food system or a new era of trade-based political leverage. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.